Good morning, everybody. This is Billy Trout, Manager of Taxpayer Education for the Tennessee Department of Revenue. And on behalf of our Commissioner, David Jaragino, and others in Taxpayer Services here and other staff that we have for you today, we want to welcome you to today's presentation of 2025 legislative updates. So we have our special guest with us today, Mr. Jeff Foster, with our legal division, who will be walking you through major pieces of legislation that passed during the last legislative session. And as Jeff will tell you, it's always very interesting. We have certainly spent a lot of time here in our department and in taxpayer services, and of course with Jeff and his legal staff looking at various bills that do become, or some do become legislation that we have to make some careful considerations about. So with that, I will go ahead and turn this over to Miss Katie Julian for some housekeeping issues here, and then we'll go with Jeff and we'll go ahead with our presentation today. So thanks again, everybody, for your participation.
Thanks, Billy. Hey, everyone. Thanks for joining us today. Always one of my favorite webinars of the year. Love hearing Jeff's commentary and explanation of how these bills came about, or at least with some of them. Really looking forward to that. But a few housekeeping things first. Mainly, we will be recording this, and a version will be available on our website either later today or in the morning. You can go to our main site, tn.gov/revenue, click on Taxpayer Education, and then Tax Webinars, and there's a webinar video library on that page. If you have the PDF of this presentation, which you can get to, I put a link in the chat, and also you can scan the QR code you see right there, then all of the links, the blue links that are within this are, you can access them via the PDF, obviously not via this WebEx screen. So download that PDF. We probably won't have a lot of time for questions. I think Jeff said that it takes about an hour to get through all the different bills that pass. So if we do have some time for questions, we'll open up the chat at the end. If not, you see here on your screen a way to email us or call our general tax line for questions. We'll share this again at the end. Without further ado, I will go ahead and hand things over to Jeff Foster, one of Revenue's finest here. So thanks, Jeff.
Well, thank you, Katie and Billy. It's always a pleasure to do this with everybody, and I want to thank everybody for tuning in to the session. It was a busy session and an interesting one, and several interesting items came out of it. And so without further ado, we will just get started. I did want to point out some interesting stuff on our website before I get started here. The legislative summaries, which we've been doing the last few years, are really, really helpful. And they set forth a summary of all the big bills that have come out, not just this year, but for the last several years. So I encourage you to take advantage of the summary. There's not only a summary that are done by our personnel, but there's also a link to the PDF of the public chapter itself, which is real helpful. So let's just jump right in. And the first group of taxes that I want to talk about are sales and use, and that's no surprise that they would be first. As all of you, I'm sure, know, sales and use is the big revenue generator for our state. It accounts for a little over 60% of all the taxes that we collect. We have a high cumulative rate, meaning the state rate of 7% and the local option rate, which can go up to 2.75. And that almost has to be the case, given that we don't have a personal income tax. We've never had a general personal income tax, and even the old Hall tax that was applicable to bonds and interest and things of that nature went by the wayside a few years ago. So really, sales and use is the revenue generator for the state. The first item that we have is Public Chapter 335, and that deals with the Retail Accountability Program, or RAP, as it's commonly known in the tax community. So a little background information about WRAP. So several years ago, the department was having difficulty auditing retail sellers, really mostly convenience stores, of certain items that they commonly sell. So think beer, tobacco products, food, candy, and non-alcoholic beverages. So the problem really was that these taxpayers often didn't keep sufficient records from which to conduct an audit. We would go in and find, the records weren't in good shape. And when that happens, that puts not only the department, but the taxpayer in a tough position, because if you can't reliably audit, then you end up having to estimate a lot of things and know it's just not a good situation for anybody. So to try to help remedy that, in 2012, the legislature enacted a law to require wholesalers of these products that we're selling to these taxpayers to file reports with us detailing their sales to these taxpayers. So we would get these reports, the department would, and then we would compare them to the taxpayers' tax returns, to the reported sales on their tax return. And if the discrepancy was large enough between what the wholesaler said that it was selling to these folks and what the taxpayer said that it was selling from what it bought from the wholesalers, we would issue a notice of proposed assessment for the tax on the underreported sales. So this law came in really two different phases. The first phase, it was just beer and tobacco. That went well. We had good results from it. So a little later, food, candy, and non-alcoholic beverages were added. So the part of the law applicable to food, candy, and non-alcoholic beverages was set to expire on July 1st of 2025. And this bill, or now law, Public Chapter 335, simply makes that requirement permanent. So those wholesalers will continue to have to send us the reports so that the department can administer the WRAP program in the future. All right, the next sales and use tax item deals with the broadband infrastructure sales and use tax exemption. So in 2022, the legislature enacted a sales and use tax exemption for items used to provide broadband communication services and internet access. So companies that were providing these services would be able to buy these items tax-free in order to provide this service. And of course, the purpose of the exemption was to encourage companies to provide these services, because they were actually lacking in certain areas of the state, especially in rural communities. So the legislature thought it would be wise to encourage this by exempting these items that would otherwise be taxable. So, like I said, the exemption came in 2022, and it originally had a 3-year period. It was scheduled to expire on June 30th, 2025. Now, I'm not sure why it was limited in the beginning. It was probably because of fiscal reasons. Perhaps the legislature just wanted to see how it was going, how much it was costing at the end of the period. So the sunset period was June 30th, 2025. And this public chapter 449 this year simply extends that for 2 more years to June 30th, 2007. So the exemption is valid for 2 more years. And at that point, I'm sure the legislature will look at it anew and decide if it's making fiscal sense and see how it's working and perhaps extend it again. But that is the current state of the broadband sales and use tax exemption. All right, our next sales and use tax item deals with temporary sales periods. It's Public Chapter 493. So just a bit of background. Under the sales and use tax law generally, all sales of tangible personal property are subject to tax unless they are specifically exempted under the law. So as a threshold matter, default matter, everything is taxable if it's sold for consideration unless it's exempted. Now, the law contains, as long contained, exemptions for temporary sales periods conducted by certain types of entities within a specific time frame. So, for example, on the books right now, volunteer fire departments are allowed to make sales tax-free as long as they conduct no more than 4 temporary sales period per calendar year. And that's just one of the, there's other Girl Scouts, certain other charitable entities are allowed to do this, but the volunteer fire departments are one of the ones that are on the books right now. So what this public chapter 493 does, it extends the same treatment that the volunteer fire departments currently enjoy to bona fide religious institutions. So it increases from 2 to 4 the number of temporary sales periods that a bona fide religious institution may participate in, and without having to register to collect sales tax on sales made directly to consumers during these periods. So as long as the religious entities or institutions rather adhere to these parameters, they will not have any duty to collect tax or to remit tax or anything like that. So anyways, just putting those folks basically on par with some of the other charitable entities, and namely the volunteer fire departments. All right, our next sales index item is interesting, and it's really an allocation measure and not a taxability measure. So a lot of times the focus, in the department and the public is the taxability of things, like what is taxable, what's the rate, how is it collected, things of that nature. How is the money brought into the department, right? So allocation is the flip side of the coin. It's the other side of the coin of what we do here at the department. It is super, super important. And basically what that means is after we collect the money, the sales and use tax money, we then have a statutory duty to allocate it to the entities that are named in the statute. This deals with the state sales tax on the sale of tires. And so to help you understand that a little bit, I want to step back and explain just briefly how the state sales tax is allocated generally. So under the general law, the 7% is allocated as follows. So 1% of the 7, or in numeric terms, it's about 14%, goes straight to the general fund under this general formula. 0.5 of the 7 goes to K-12 education, and the remainder is 5.5 of 7, and that's about 78%. It's split up between various recipients. 1 being the general fund, 2 educational purposes, and 3 the incorporated municipalities get a chunk based on primarily on their population vis-a-vis that of the state. So that is the basic formula of how the state sales tax is allocated. And there are many exceptions, specialty districts, tourism development zones and that, but in general, that is the basic formula. And it's set forth at a statute at 67-6-103. And if you want to read a Byzantine statute, I encourage you to check that out. So anyway, that is the basic formula. So to go back to tires, so tires are just a type of tangible personal property, right? There's nothing, or prior to this year, there was nothing in the statute that mandated a special allocation for tires. They were just TPP. They were allocated like in anything else. But this public chapter changes that. And so it says we're going to allocate the 5.5 of the 7, or about 78% of it from the sale of tires, to we're not going to send it as per the normal formula, but instead we are going to send that money to the state highway fund for sales occurring on or after July 1st of 2025. And of course, that makes sense, right? The highway fund is used to fund the building and repair of infrastructure like roads, building bridges, old overpasses, things like that. Tires are used constantly on the road, so it really makes sense if you want to create more money for the state highway fund and roads and things like that, that you would sort of target tires. And we've seen this over the last few years, like trying to get more money to repair and build the infrastructure in the state that so badly needs it. We saw it several years ago with the act that raised the gas tax and the diesel tax, and those tax increases were specifically earmarked for projects. And this doesn't have the specific earmark, but it is nevertheless, the legislature thought it wise to divert the money from the sale of tires to the highway fund instead of having it just go into the general pot.
Hey, Jeff, just real quick,
Bill?
just a little comment here.
Sure.
We have already developed the new sales tax return that has an additional line item to reflect the sale of the tires. It will be with the July returns due in August, okay, or after, of course. And of course, a good reminder, if you don't sell tires, it'll be zero, okay? So the 10 tap system will be updated, as well as the paper form on our website as well, to reflect that extra line on there now. Thank you very much.
Oh, thank you. Thank you. That's great information. All right, moving on from tires to something altogether different in the sales and use tax realm. This public chapter 517 deals with uranium enrichment and nuclear energy production facilities, and this makes some big changes in with regard to this stuff in sales tax. So under prior law, the enrichment of uranium on a cost plus or total enrichment basis was designated a taxable service. And so it was subject to the normal sales tax. So the first thing this bill does is get rid of that. It removes that from being a taxable service. But it doesn't stop there. Second, it adds machinery and equipment and repair parts and things of that nature that are used in enriching and converting or reconverting uranium products. It adds those things to the definition of industrial machinery in the statute. And that means, of course, that all of this stuff, this machinery, the equipment, everything that's used to create the energy can be purchased tax-free now as industrial machinery. And that is a huge, huge benefit to manufacturers, being able to, this stuff is very expensive. All this infrastructure that you have to purchase to do really any kind of manufacturing, but certainly this. So that's an enormous boost to the nuclear energy production industry. Finally, another very significant change that it makes is that for the first time, a nuclear energy production facility is labeled or is designated a certified green energy production facility. Now, what that does that designation makes it eligible for the pollution control credit. And that is a sales and use tax credit, which allows manufacturers who are doing something or building something and they create pollution during the course of that process, they can purchase things that take care of the pollution, that treat it under environmental rules and regulations, tax-free. So this is new for nuclear production facilities. Previously, the only certified green energy production facilities were facilities that dealt in geothermal, hydrogen, solar, and wind. So this adds nuclear energy to that group and makes it eligible for the pollution control. So again, a big boost to nuclear energy production facilities. There is an important notice that lays this out, 2509, if you're interested in that. The effective date is July 1st, 2025. So it's a new day for nuclear energy, at least in the realm of sales tax. All right, so that's really all we have in this session regarding sales and use tax. We do have a few interesting items with regard to franchise and excise, or F&E as it's very commonly known in the tax community. Just a quick, I'm sure the vast majority of you know this, but franchise tax is a sort of a species of property tax. It's now, after last year's law change, based only on the net worth of a taxable entity. It is the assets minus the liabilities calculated under the GAAP accounting principles. So that's franchise. Excise tax is an income tax, essentially. And this public chapter 343 deals with the tax base for the excise tax. So kind of start at the beginning here. To determine the excise tax base, you first figure out federal taxable income, right? That's the starting point. So if you're a corporation and you file an 1120 federally, that's going to be line 28 of that tax return. So then you take that starting point and you make the Tennessee specific additions or subtractions that are set forth in section 67-4-2006B. So that is how you get to your excise tax base normally. And then, you apportion if that's appropriate, and then apply the rate and credits and so forth to get your liability. This public chapter is a major change in the law because it allows a taxpayer to choose to add back federal deductions that were taken in arriving at federal taxable income, or state subtractions, if doing so does not lower the tax base. So it effectively allows taxpayers to increase the tax base. So why would a taxpayer want to do this? Why would any taxpayer want to do this? Well, I think the answer is that some large taxpayers, often publicly traded, have large amounts of tax credits on the books, such as job tax credits or industrial machinery credits. So what happens is they create these credits, and by fulfilling the statutory requirements for doing so, and then they get to offset their liability with these credits. Now, a lot of times the credit is much larger than the liability, so the law allows them to carry forward the credits for a specific period and continue to apply them to the liability as it occurs each year. So that's how it works normally. There have been changes to the F&E law in the last few years that have potentially lowered the liability for some of these big taxpayers, and not just them, but in general. I think of the adoption of the single sales factor a couple of years ago, the repeal of Schedule G for franchise tax purposes last year. So what that means is with the reduced liability, there is a danger that some of these big taxpayers with large credit balances might not be able to use their credits before they expire. So why is that a problem? What difference does it make? Well, it matters because of financial reporting. These large companies have a duty to report to the SEC, to the stockholders, about all kinds of things. One of them is the tax deferred assets. And they, rather than having to redo all that and go through all that regulatory stuff, some of them actually wanted to increase their base so they can use these credits against that. So that is why I think, is my understanding, that is why Public Chapter 343 came into play. It's a very interesting provision, in that it is sort of a tax increase, but it's at the request of the taxpayer community. So that is a major change in the administration of FF&E. Another one that's really sort of a niche issue, but I find it very interesting. I worked on it personally in this last year. Deals with agricultural co-ops, and it's Public Chapter 455. So ag co-ops that are, cooperative organizations that are supposed to support agriculture and farmers and whatnot, have been exempt from state taxes, almost all state taxes, for a very long time. So the statute was enacted in 1939, and the statute is limited to ag co-ops organized as corporations. So way back then, that was no problem at all with regard to F&E law, because for many, many years, only corporations were subject to F&E, right, for a long time. But in 1999, that changed, and the F&E law was amended and expanded to make it applicable not only to corporations, but to limited liability pass-throughs, right? Like your LLCs, your limited partnerships, entities like that. But in the meantime, the separate statute is a completely different part of the code. It's not in the tax part. Still said that ag co-ops were exempt if they were corporations. So what happened is, in the past year, an ag co-op organized as an LLC received an assessment from the department, and it didn't like it, right? It's like, wait, hold on, we're exempt from F&E. We have been for 80 years, 90 years. What's going on? And we looked at the statutes, and it was pretty clear, like, well, the intent is to make these entities exempt. But on the other hand, we have to read statutes as they're written. We have to read them literally. So we just felt like our hands were tied, because the statute says the exemption applies if you're organized as a corporation. We're sorry. And that taxpayer, very understandably, was not happy. And I assume and understand what happened is that they went and talked to their folks and got the law changed. So Public Chapter 455 changes the prior law to provide that the exemption applies however a taxpayer is organized, not just corporations, but LLCs, limited liability partnerships, or any other entity. So it solves a problem in the law that had just gone. It was sort of under the radar for years. There's not a whole lot of these entities, I don't think, out there. I'd certainly never seen the issue in my years with the department, but it came up and they got the law changed, which is a perfect example of how to solve an issue, to solve a problem. All right, our next F&E item is Public Chapter 496, and it deals with the Community Investment Tax Credit. So what is that? What is that credit in general? It's a credit that is provided to banks or other financial institutions for making loans to entities providing affordable housing. And it's based on, you get a certain percentage of the amount of the outstanding balance of the loan is how it basically works. So previously, under prior law, the credit was based on the unpaid balance of the loan as of the end of the year, as of December 31st. So the practical import of that is the bank was really stuck with whatever the amount was at the end of the year. And apparently that caused problems with trying to do forecasting and maybe some uncertainty. So this public chapter changes that, and instead of using the year-end value to calculate the credit, what it does is does a month-end average of the months over the year and uses that. So it basically smooths out the calculation and doesn't make, the bank, there might be a payment or something at the end of the year, which would really reduce the loan, right? Which would kind of mess the bank up because it was counting on a larger credit or something. So this takes some of that uncertainty out of the process and smooths out the credit for the financial institution. All right, so that is all we have with regard to F&E. So let's look at another tax that came up this year, and that is liquor by the drink, or LBD as it's known. So LBD is a 15% tax on sales of wine and alcoholic beverages, and it is imposed in addition to whatever other tax may be imposed. So think sales tax, right? So you buy a glass of wine or a cocktail or something, and you're going to pay the sales tax on it, and you're also going to pay the LBD. So it's a substantial burden. It's about 24%, but anyway, that's how the LBD tax works. So sort of switching gears a little bit with regard to wine in general, during the last few years, we've seen a really pretty substantial liberalization of the law governing wine and wine sales specifically, especially those made on winery premises. We've seen legislation come in sort of opening that up the last few years, and this public chapter really continues that trend, and it provides an exemption from LBD for the sale of wine for consumption on the premises of a winery or a farm wine producer or satellite facility. And it includes, it's broadly based. It includes sales of wine by the glass, tasting samples, and wine sold at retail in sealed containers. So again, you're seeing the liberalization of this to try to support the wine industry. We've got a number of wineries that are in operation throughout the state. It's a growing industry. So the legislature thought it wise to try to support them by exempting certain sales from the LBD tax.
Okay. Jeff, before you go any further, I just want to throw something out there for those that are maybe looking at this recording later that we're going to be posting online. We're currently working on a great tax manual also on LBD tax, all the liquor by the drink, anything relating to actually anything a restaurant or a bar might engage in. So it's going to be very comprehensive, including sales tax, F&E, LBD, all the acronyms here. So we're currently reviewing that as we speak today, and that'll be posted on our website in our tax manual section under industry specific guidance. So look for that in the next upcoming weeks to go out there. Okay.
That sounds great, Billy. I know if I was opening a restaurant, I would want that guidance for sure. Okay, so moving on to another kind of local, it is a local tax. It's the occupancy tax. It's an interesting tax. It's come up in the law quite a bit in the last few years. So what is the occupancy taxes generally? It's a local tax that allows counties and municipalities to, by resolution or ordinance, impose a tax on the rental of hotel rooms or short-term rental units. So short-term rental units, think of units that are rented by, you know, the Airbnbs of the world or the VRBOs or what have you. So the way it works for the hotel stuff, that's a very local. The renter pays the tax to the operator of the hotel. The operator remits it to the local jurisdiction. It's different with the short-term rental units. The operator remits it to the Department of Revenue, who then turns around and allocates it per statute. So under the prior law, if the length of stay extended for 30 days, the person who paid the tax could apply for a refund from the operator, and in turn, the operator could get a refund from the local jurisdiction. So this law changes that, Public Chapter 364, it changes that to provide that the first 30 days of a stay are taxable, no matter how long the stay is. The remainder of the stay is tax-free, but the first 30 days are going to be subject to tax. And that's a change, and it's just create more revenue from the occupancy tax for the local jurisdictions, which now have to use the proceeds to promote tourism. So we have another occupancy tax item from this session, Public Chapter 372, and it really deals with the rates that municipalities can charge. So to kind of set the stage a bit, in 2021, the legislature really overhauled this whole tax. Before that, it was kind of a hodgepodge of things. You had the local occupancy tax that was done by private act, right? You had all kinds of, you did have a general statute, but it had all kinds of strange carve outs in it for different counties and whatnot. So in 2021, the legislature decided to overhaul the whole business and provided that a city or county could enact a maximum rate of 4%. It did have a grandfather provision that provided if you already had a rate in there, you could carry it forward under certain conditions. So that was great. It really served to kind of standardize things and make this a much more easy tax to administer. But since that time, an issue has arisen as to what would happen, right, if a county adopts the max rate and a city within that county also adopts the max rate, right? What would happen? Would the rates be stackable? Would they both apply? So that came up, and the various agencies who are sort of involved in this issue, namely us and tourism, said, yeah, we think so. But this led to some strange results, because the grandfathering that I mentioned allowed, there were some high rates because, you know, they were sort of one-off things back in the day. So it led to these strange, like really high rates. So this bill, this now public chapter, aims to fix that, right? Say you can do a 4% rate, but the cumulative tax that you're going to pay is 8%. So it's trying to get the hold of some of this stuff that has come up lately with regard to, you know, the stacking and these sorts of issues. All right, the next couple of items deal with the litigation tax. And the litigation tax or taxes are they're really more like fees. They're set forth in the statute, and they basically are fees that on the privilege of bringing and maintaining certain types of lawsuits in the various courts throughout the state. And they're all types of different litigation tax and fees. They are pursuant to the statute. They are allocated very specifically to certain funds and whatnot. So this year, there was some action with regard to that. Public Chapter 459 deals with an existing tax, and it simply increases from $1 to $2 the fee that's collected in municipal court cases. And it uses this money to defray the cost of training and providing continuing education for the municipal court judges and their staff, their clerks. And it's really just to try to further educate these folks and make their jobs easier, make them more increase their training. But we also had a new litigation tax in Public Chapter 486, and that simply establishes a $2 privilege tax on litigation in all civil or criminal cases. There were already these fees or taxes on the books for cases that were instituted in juvenile or municipal courts, but this establishes across the board $2 privilege tax. And similar to the previous item, it's to be allocated to the court clerk continuing education account, just to provide more resources to the clerks and more education. All right, let's change gears pretty substantially here to the tobacco tax and vapor. So vapor, I'm sure this has been in the news a lot. The whole vapor industry has just really exploded over the last few years, and with huge increased sales and use, and maybe some perceived problems with youth use and so forth. So in light of all this sort of background, the legislature decided to try to maybe get a better hold on all this stuff going forward. And they did it in Public Chapter 324, and it's a big bill, a sprawling bill. I won't try to tell you or explain everything in it, but the basic intent of it is to treat vapor products like tobacco, like cigarettes. So how they do that, first thing they do is establish a registry for vapor products, and the manufacturers have to apply to have the products put on the website, on the registry, pardon, and the products cannot be sold legally unless they are on that registry. Along with that, it requires the Department of Revenue to conduct inspections at the retail locations where such products are sold, and wholesale where they're distributed. And if we find stuff that is not on the registry, then just like cigarettes, they're going to be confiscated as contraband. So again, just trying to get a better hold on this stuff, trying to treat it basically like tobacco. With regard to the tax, it establishes a wholesale tax on vapor products at the rate of 10% of the wholesale cost price. And again, that's similar to how it's done with cigarettes. So it's really trying to recognize that this is a big industry, and it's trying to treat it similarly to tobacco and cigarettes in particular. So a related bill deals with the hemp products, the hemp-derived cannabinoid products, Public Chapter 526. So again, this is a very sprawling bill, and it would take a very long time to try to hash out completely what's in it. So I won't try to do that, just hit the high points. So this started a couple years ago with the hemp law, which sort of got all this started. But since then, in the view, I think, of the legislature, the sale of hemp products has exploded. It's the sales volume, the distribution, all of that, reaching a much larger audience and so forth. So this whole public chapter is supposed to get a bit better control over that. So how does it do it? It does it in a few steps. First thing it does, it tightens the definition of hemp products, and it flat out bans certain types, which the legislature deemed too dangerous, too prone to be used in just too dangerous of a way. It regulates the amount, the serving size, the amount that can be in a serving of depending on how the product is used. It prohibits online sales and vending machine sales, and it limits where hemp products can otherwise be sold. And these are essentially places where alcohol could be sold, right? If you have a LBD license or a retail liquor license or something like that, or you hold a special hemp license, then it can be sold in those places. Like the vapor law and like by extension the existing tobacco law, it creates a registry, right? So for the products and requires suppliers to register these brands with the department. Another thing it does, it gives the responsibility for the enforcement of the act and the inspections and all that stuff to the ABC, the Alcohol Beverage Commission. So they're the ones that are going to go out and do all the inspections and things like that. So what's it do with regard to tax? So under existing law or prior law, before this, the hemp was subject to an additional 6% sales tax at retail, right? So the normal sales tax would apply, and then you would pay an additional 6%. So this does away with that, and it establishes a taxing regime at the wholesale level, which is, essentially like vape, like tobacco. And you can see on the slide there the rates that are applicable to the different kinds of products, and they are set forth. It just varies on how the product is sold, whether it's sold in a liquid form or a flower form or otherwise. But it completely changes the structure of all this, and again trying to get a better hold on, I think. All right, we have a few that are I would say fall into the miscellaneous tax category. The first one, Public Chapter 285, deals with the mineral severance taxes. So the counties, just the counties, not cities, are authorized by statute to impose a tax on certain minerals that are removed from the ground in their jurisdiction. So think, sandstone and chert and things like that. So the rate of this has been the same for many, many years. I believe since the 80s, it's been 15 cents a ton. So this bill, it changes that by allowing counties to come in and raise the rates for future years. And again, it's all about roads. It's supposed to go to the county road funds to increase their proceeds and to help build and maintain road infrastructure. The next tax we have, next miscellaneous tax, deals with the bail bond tax. So this is a kind of a niche tax. Tennessee law imposes a tax of $12 on every bail bond that's issued. The tax is to be collected by the bail bondsman and remitted to the Department of Revenue. So within the last few years, we've become aware of problems with the reporting and payment of this. And again, it's largely a record thing. We went out and tried to audit some of these folks and found that the records were in disarray. And then we tried to check it with the clerks, right, who have records of the bonds that have been issued, and found sometimes that their records were that didn't match. And so to try to get a handle on this and to standardize it, this requires that both the bondsman and the clerks file quarterly reports setting forth the total of the bail bonds issued and the amount of liability for the bondsman, and for the clerks, they have to the total number and the total amount of the bail bonds beginning October of this year. And again, it's just trying to kind of get our arms around this issue and provide some standards and some reliability. All right, the last thing we'll talk about real quickly is just we have a few administrative items, and that just deals with the department's administration of the various taxes. One deals with municipalities. The municipalities have a statutory duty to have an annual audit done of all their departments and boards and agencies in their jurisdiction that receive and disperse funds, right? So under prior law, it required the audit preparer to provide a copy to the comptroller as soon as practical after the close of the municipality's year. So that must not have been happening, because this bill changes that. The first thing it does is say, hey, that your audit has to come in within 6 months after the close of your fiscal year municipality. And if it doesn't, if you have more than 2 outstanding late audits, the comptroller can tell the Department of Revenue to withhold up to 15% of your annual sales tax revenue until that's cleared up. And that is a big deal. These local people are very, very sensitive to getting their allocations. And so this is supposed to be a mechanism to get them to do their audits and submit them in a more timely fashion. The next administrative item deals with a little fee reduction. So there are various local taxes, the local option sales tax, the local occupancy, the short-term rental, business tax, coal severance, that are nevertheless administered by the Department of Revenue. And under prior law, we would get a little cut from the collections to offset our costs for doing that. It used to be 1.125%. The legislature saw fit to clip us a little bit this year to take us down to 0.75%. So that's all that's going on there. The next administrative position item is Public Chapter 501, and that deals with the calculation of population. So there are allocations of state taxes to counties and cities that are based on population in some instances. One that I mentioned earlier is the municipalities' share of state sales taxes based on its population relative to the state's overall population. But there's been some problems in the past figuring out exactly what the population is. Especially in years that you don't have the federal census that only happens every 10 years. So this bill seeks to rectify that, and it makes ECD, Economic and Community Development, responsible for certifying the population of each county and municipality and the state in general prior to July 1st, prior to the start of the fiscal year. So that is supposed to like put an end to problems about establishing population. All right, the very last one I have, and I find this just fascinating. Public Chapter 514. So to really quickly, this law builds on an earlier law that was passed in 2021, in which the legislature set up a law providing that any lawsuit challenging the constitutionality of a state statute, an executive order, or administrative ruling must be heard not by a regular trial court, but by a special 3-judge panel comprised of judges from each of the state's grand division. So that came in 2021. So this public chapter builds on that, and what it really does, it allows the Attorney General to, if it believes that a local government is violating a state statute or the Constitution, to come in and file a report basically saying that. And if it does that, the local government can either stop what it's doing, or it can challenge the AG's finding by bringing a lawsuit in front of this 3-judge panel. If the suit goes forward and the panel finds that the local government has violated the state law, the Constitution of Tennessee, then the Department of Revenue is required to withhold the state shared tax allocations to that local government. And it's not only just tax, it's all kinds of things. It's grants, it's contract money, it's all sorts of things. And, you know, there have been certain squabbles, dust-ups in the news between the legislature and certain municipalities over the last year or two, and this is sort of a outgrowth of that. So very, very interesting provision legally. So I think that I am just about out of time. And again, it has been a real pleasure to speak to all of you, and I'll just turn it back over to Katie.
That was fantastic, Jeff. Thank you so much. Does it make us, those of us that really love that, does that mean we're like nerds? Because if so,
It most
sign
certainly
me up.
does. Absolutely.
I love hearing all the backstory, but thank you all for joining us today. We only have another minute left, so I just want to fly through a couple of slides. Here's how to reach out to us. Obviously, we don't have time to take questions today, but if you have any questions, feel free to reach out to us. Make sure you follow us if you do not already. And then a couple of upcoming events we've got. Our webinar next month is manufacturing exemptions. Got some new laws to consider in that one, putting that one together. And then in September, we've got natural disaster refunds. As usual, we have our quarterly new business workshop coming up October 8th. And that's it. Billy, Jeff, anything else to add?
Not for me. I just want to thank Jeff for all his analysis and hard work. Without
Yes.
people like Jeff and the staff in our legal office, we would be lost. And we appreciate everything they do for the department and trying to explain the complexities that are involved in these laws. It's monumental. And like Jeff said early on, those legislative summaries that are on our website are gold. They really, really are. So check those out, as well as our tax manuals and notices and things like that as well.
We'll see y'all next month. Thanks again, Jeff. If you need CPE credit, just make sure you answer yes to that question on on the exit survey, and make sure you list how your name needs to be on the certificate. We'll see y'all soon.
Thanks, everyone.
Thank you.